I know you're going to learn a lot watching this video. This is Chapter 1, Accounting and Business for Accounting 201. In this recording, I will review the highlighted learning objectives. The PowerPoint located in Blackboard will review all of the learning objectives. The first learning objective that I will explain is generally accepted accounting principles. Financial accounting is governed by concepts and rules which are called Generally Accepted Accounting Principles, or GAAP. GAAP aims to make information that is relevant, reliable, and comparable. Relevant means that it affects the decisions of the users. Reliable means that the information can be trusted by the users, and comparable means that it's helpful in contrasting between or among organizations. There are two types of accounting principles: general principles, which are the basic assumptions, concepts, and guidelines for preparing financial statements, and specific principles, which are the detailed rules used in reporting business transactions. The four principles are the measurement principle, also called the cost principle, which means that accounting information is based on actual cost measured on a cash basis. The revenue recognition principle has two parts. Revenue is recognized when the services are performed or when the goods are provided to the buyer, and revenue is recognized at the amount expected to be received from the customer. Usually this is an amount in cash. The expense recognition principle, which is also called the matching principle, states that the company records expenses incurred to generate the revenue reported. The principles of matching and revenue recognition are key to accounting. The full disclosure principle means that a company reports the details that would impact the user's decisions. Now let's look at the four fundamental assumptions of accounting. The first is the going concern assumption, which means that the business is assumed to continue in operations into the foreseeable future. The monetary unit assumption means that we will record our transactions in monetary units, which would be the dollars in the United States. The business entity assumption tells us that we must separate the transactions of the owners from the transactions of the business. And finally, the time period assumption means that we can separate into specific time periods, such as months and years. Now we'll look at the accounting equation. The accounting equation is assets equals liabilities plus equity. Assets are the resources that a company owns. They include cash, supplies, equipment, and land, and also something called a receivable. This is an amount that would be due to the company from a customer. Liabilities are the creditor's claims on the assets. The term payable means that there will be a future outflow of cash to a creditor. Examples of payables are wages payable to the workers and accounts payable, which would be paid to our suppliers. And equity is the third part of the accounting equation. Equity is the owner's claims on the assets. It's also equal to assets minus liabilities. And it's also called net assets or residual equity. Equity is increased by stock and from revenues, and it's decreased by expenses and dividends. So let's talk about the four parts of equity. So one is common stock. Common stock reflects the inflows of cash from the stockholders in exchange for stock. Dividends are outflows of cash to the stockholders. Revenues are increases from the sale of products or services to our customers, and expenses are decreases to equity, and they are the cost of providing the products and services to our customers. So now we're going to look at various transactions that affect a business. We will look at 11 transactions of FastForward Company. Chaz Taylor invested $30,000 in cash in exchange for common stock. So first we have to identify the types of accounts that are affected. So cash came into the business, so cash is increased, and common stock was provided, so that also increased. So this is what it looks like when we look at the accounting equation. Cash went up $30,000, as you can see here, and equity also went up. And then you can see the balances here, 30,000 assets, 30,000 on liabilities plus equity. So the accounting equation is in balance. The next transaction, the company purchased supplies and they paid cash. So what are the accounts? Cash went out of the business, so cash decreased, and supplies came into the business, so supplies increased. Both cash and supplies are assets. So one asset went down, one asset increased. So this is what the accounting equation looks like now. So you can see that both of the cash and the supplies are on the asset side. So we have one going up, one going down. And the accounting equation is still in balance. The next transaction, the company purchased equipment and they paid cash. So again, we're going to look at the accounts. They paid cash, so cash went out of the business, it decreased. Equipment came into the business, so equipment increased. These are both assets, just like the supplies and the cash in transaction 2. So this is what the accounting equation looks like now. Again, we just have cash going down and equipment going up, both assets. So only the asset side was affected, but the accounting equation is still in balance. Transaction 4, we purchased supplies on credit. So here we have supplies, which is an asset, going up. Accounts payable is a liability, and it also is increasing. So let's look at the effect on the accounting equation. So now we have an asset going up and also a liability increasing. And again, we're still going to have our accounting equation be in balance. So accounts payable is something where we, in the future, will have to pay our supplier for that. The next transaction, we provided services for cash. So now we're earning revenue. So cash is going up because our customer paid, and revenue also is going up. Revenue is on the equity side. So this is what the transaction looks like now. Our cash went up and revenue and equity also went up. And you can see that the accounting equation is still in balance. The next transactions, 6 and 7, are payments of expenses in cash. So we have 2 transactions here. We paid rent and we paid our employees. So we paid in cash. Cash is decreased. Our rent expense goes up, but equity goes down. And salaries expense goes up, but again, equity goes down. So let's look at the equation. So here you can see cash went down, expenses went up, but the effect on the accounting equation is that equity decreased. But again, our accounting equation is still in balance. Transaction 8, we provided services and facilities for credit. This means we provided a service, but our customer didn't pay us today. So this is an account receivable. So our accounts receivable, an asset goes up, consulting revenue and equity also increased, as well as rental revenue. So here we can see the accounting equation. Our accounts receivable instead of cash went up, and then we have two types of revenue that increased. And our accounting equation is still in balance. Transaction 9, we received cash from that account receivable. So our previous accounts receivable customer is paying us now. So our cash will go up and our accounts receivable will go down because they paid us. So they're both assets. So the accounting equation now, both on the same side, cash goes up, accounts receivable goes down. And we are still in balance. The next transaction is payment of accounts payable. So now we're paying a partial payment on the amount that we purchased in transaction 4. So our cash will be decreased as well as our accounts payable. Both of these will be decreased. So here's transaction 10, cash goes down, accounts payable also is decreased. So now we only owe $6,200. Transaction 11, we paid dividends. So we have cash, which will be decreased, and dividends, which will be increased, but we're looking at the effect on the accounting equation, so equity is decreased. So here we have $200 decreased, dividends increased, but dividends decreased equity. This is a summary of the transactions, and you can review this or print it from the static full PowerPoint for Chapter 1. So now we're going to look at the financial statements. We have 4 financial statements. The income statement is the first statement to be prepared, and it includes the revenues and the expenses. The difference between the revenues and the expenses is your net income or net loss. Next, we prepare the statement of retained earnings, which explains the changes in retained earnings from the beginning of the period to the end, and you include net income or net loss and also dividends in the statement of retained earnings. Next, we have the balance sheet, and the balance sheet is a snapshot of the accounts as of a certain date. It includes the assets, liabilities, and equity. So we bring forward the amount from retained earnings to the balance sheet. And then finally, the statement of cash flows, which shows the cash inflows and the cash outflows over the period of time. So it shows how you went from the beginning period cash balance to the ending period cash balance. So these are the 3 financial statements: the income statement, the statement of retained earnings, and the balance sheet. So the first statement is the income statement. It's prepared as of a period of time. This covers a month. It includes the revenues, which total $6,100, and the expenses, which total $1,700. $6,100 minus $1,700 is $4,400 net income. Then we prepare the statement of retained earnings. This also covers the period of a month. We began with 0 balance. We added our net income. This is why you have to prepare the income statement before the statement of retained earnings. Then we subtract the dividends, and that gives us our ending retained earnings balance, which is used in the balance sheet. So that comes in here. Notice that the balance sheet is a snapshot on the day we prepare it. It includes our ending balances for assets, liabilities, and equity. And again, the retained earnings ending balance is brought forward from the statement of retained earnings. Now, one very important thing is the total assets will equal the total liabilities and equity. Notice that our ending cash balance is $4,800. So you'll see that on the statement of cash flows. So here is the statement of cash flows, which is also prepared for a period of a month. Our ending balance is $4,800, so you will see that here. And then we have three categories. We have operating activities, investing, and financing. So under operating, we have our cash received from our clients, cash paid for our expenses. The difference between the cash inflow and the cash outflow is net cash provided by operating activities. And then under investing, we have long-term assets. So they purchased equipment and they paid cash. So that's a cash outflow. So net cash used by investing activities. And then under financing, we have the investment from the shareholders and the cash paid to the shareholders for dividends. Subtracting these two, we have net cash provided by financing. Combining these three, so we have two positive numbers and one negative. We'll add the two positive, subtract the negative number to get the net increase in cash. And of course, this was the first month, so we started off with a zero balance. So 4,800 plus zero equals our ending cash balance of 4,800. This concludes the lecture for Chapter 1.